many companies will reward employees with shares in the business. And after a certain period of time, employees are allowed to sell those shares if they wish to. A friend of mine recently who works for BT eventually came up to me and asked me, should I sell these shares in this company, or should I hold on to them for the next 10, 20 years? Now, there's a ton of responsibility on me to give advice on this, and it was just friendly advice. But what I'm going to do is I'm going to send them to this video and let them make their own minds up based on the facts that I have found. I think that's the best way to advise people, to give them the facts and allow them to make their own decision based on those facts. Now, I'll give you my opinion, but you should always do your own research. But today, we're going to take a look at that company, BT. Okay, so just some facts and figures that I always start our shows off with. In the last year, this share price has fallen 44%. In the last 2 years, it's down 46%. Over the last 5 years, down 72%. Despite that, the volume per day of shares traded in BT is 24 million. So bear in mind, Diageo, who are one of the strongest companies we've seen on this show, trading 5 million shares a day. Rolls-Royce, one of the worst companies we've seen so far on this show, trading 14.4 million shares a day. BT, 24 million shares. So not quite Vodafone level, which was, 80 million, but up there. And again, we generally see this trend of the less favourable companies in terms of long-term investments have most shares being exchanged on a daily basis. And I think that is that tells you a story at least. One of the big pluses of BT at the moment is their dividend yield of 12%. Now, I'm not a dividend investor, as I've always said, but a 12% dividend yield is actually pretty good. If you're going to get 12% return a year from their dividend, now that's assuming they're paying a dividend in 2020 amid all the crisis that's been going on. Many companies have cancelled their dividend, but if they haven't, you're looking at 12% dividend at the moment. That may all change in the future years, but right now that's pretty solid. I'm not a dividend investor. I can make better than 12% a year on the picks that I'm making. So, even the best dividends out there aren't appealing enough for me to bring these companies into my portfolio. But yeah, I mean, you could understand if somebody was putting BT into their portfolio purely on the dividend yield. Otherwise, as you're about to see, not the greatest investment. Okay, let's take a look at BT then. Epic code BT.A. FTSE 100 company, very popular amongst many beginner investors, this company. The sector is obviously telecommunications. So, first of all, looking at the revenue, we have seen quite some drop-off from 2009, I would say. Looking at 20.7 billion, 21.3 billion back then. And then we saw it fall all the way down to about 17.9 billion over 2008 to 2015. And that was a relatively consistent drop-off as well. So everything moving in the wrong direction there, shrinkage in the company rather than growth. Over the last couple of years, I'd say probably 2017 to 2019, they've been stuck at a certain level. Again, we've seen it, we kind of saw it spike back up to 24.0 billion, a level that we hadn't seen since 2008. So that was a fantastic year for BT in terms of revenue growth. Let me stress that, in terms of revenue growth. So we haven't gone through the rest of it yet. Not necessarily a great year for them. But in terms of revenue, it was the highest revenue they'd seen come in. But then since then, again, we've got consistent drop-off, 23.7, 23.4. It's not a tremendously fast drop-off, but it is a trend in the wrong direction over the last 2 years. And we're not far off the 2009, 21.3 billion. So growth at BT hasn't been super impressive, but it's not terrible. There is some growth there. It's just, it really feels like it's kind of tailed all the way down to 17.9. It's in a bit of a jump over 2016 to 2017, and it's starting to go back down again since then. It's not the kind of growth that I'm looking for, but there is some growth there, so it's not awful. There's nothing in gross margin because they provide a service more than they provide a product, so I guess they haven't got anything in cost of sales and everything's factored into expenses. Expenses are very high. We're looking at, they've gone down a little bit, but I mean, we've gone from 90, 100, 91, 89 in 2008, 2011 in terms of percentage of the gross profit. Expenses have fallen to about 85% now. We've been there for the last 3 years. It's a bit high. When we're bringing in 23.4 billion, but 20 million of that is being spent on expenses alone in running the business, it doesn't leave them with much margin. As we come down here, nothing in R&D, nothing in depreciation, so that's not an issue. But we've got interest on debts quite high, 22%. I would imagine that probably would reflect the fact that they're taking on quite a lot of debt. We'll come to that in a moment, but that's a big chunk of your profit to be losing again. And then we come down to the actual net earnings of the business, and they're okay. You know, I mean, from 2008 to 2011, very unimpressive at all. I mean, had an average net earnings of about 3% a year over those years. It's definitely improved, certainly over the last, what we're looking at here, the last 8 years. They've got an average of about 10% a year. It's okay. It's nothing particularly exciting. It's certainly gone up over the last 3 years, but it's down from the previous 3 years to that. So again, it's a little bit inconsistent. There's no obvious trend, but there is some general growth there. But it's very average. You know, 8%, 8.6%, 9.2% a year. It's okay. But there are far better companies out there to be putting your money into, in terms of certainly the income statement. Coming down to the balance sheet, we have just pretty much got just enough assets over liabilities here. So that's okay. Again, not very exciting. Nothing to really get the investor juices flowing there, but they look all right. Short-term borrowings, 2.1 billion. Long-term debt, however, 14.7 billion. Now, again, I always say this pretty much every episode. The amount they're borrowing isn't the issue. It's how much they're borrowing relative to the earnings potential. Or, in other words, relative to their ability to pay it off. That's how you know whether or not they're biting off more than they can chew. And we simply do that by taking the earnings and working out, okay, in that case, based on what they're earning, how long would it take them to pay it off? And we're looking at a ratio of 6.8 or otherwise 6.8 years. It's too high for me. I don't like that. It seems too high. It has been too high for a while. So that's a concern for me. And there's another reason why I wouldn't want to invest in BT, purely because I just don't like the size of the debt that they're carrying relative to their earnings ability. Retained earnings are somewhat of a mess, into so much that they've got money in there, then they're in the negatives, then they're in the positives, then they're in the negatives, and it seems to bounce around an awful lot. When we're looking at 2019 and they're sitting on 3.3 billion, which is a respectable sum, considering they had 5.4 billion in 2008, that would suggest to me there is no retained earnings growth going on here, and there isn't. They obviously are repeatedly dipping into this pot, and there's no consistent growth there. Now, when we look at some of the companies that I invest in fact, every single one of them that I invest in have a strong retained earnings growth. Year on year, they're pumping 10, 15, 20% extra into this pot. They're certainly not taking out of it unless there's an acquisition of another business that they're bringing in which case that's what it's for. Unless there's economic issues in the underlying performance of the entire market, which we really haven't had since 2009 onwards. And the other reason they might be dipping into retained earnings might be for a special dividend or to purchase assets that can lead to revenue growth. Clearly, we're not seeing that revenue growth. So if they've been dipping into this to buy assets in the business, then they've been poorly purchasing assets because those assets have not really put more money in the shareholder pocket. And so the board would surely be held accountable for spending all those billions and not really having anything to show for it. That's a concern for me. I'm not particularly keen on BT by the looks of things right now. Return on shareholder equity, 21.2%. That's okay. That's quite a solid figure. So they are, based on the level of equity that they have, i.e. the assets minus liabilities equals the shareholder equity, the return that they're getting off that equity is okay. It's pretty solid. They are spending quite a bit of money on property, plant and equipment every year. That puts me off. I'm not really interested in companies that have to spend quite a big chunk of the profits on property, plant and equipment to stay where they are. I'm not keen on that. There are far better companies out there that don't need to swallow a big chunk of their profits to be invested in things that rust, rot and depreciate in value. So again, that's another reason why I wouldn't be necessarily that keen on BT. So let's go and take a look at the charts. And much like all of the companies that we see down towards the bottom of the table, I mean, they're all the same shape, pretty much. They're all lower than they were in 2008. BT were at £3.20 a share in 2008. Today, they're at £1.25. Prior to the crash, they were just hovering below £2 a share. So from £3, what did we say, £3.20 a share in 2008, let's call it £3, down to £2 over the last 12 years. Now, of course, they've been higher along the way, probably hit highs of what looks like £4.60, maybe £4.80, but they've come all the way back down again. And this is not the kind of company I'm interested in. This is not a company that if I was to invest today, I would expect to be at £10, £15, £20 a share in 5, 10, 20 years' time. Now, you could invest in BT and do okay, maybe. You might see £1.25 turn into £3 again someday. Who knows? But I want more. I'm looking for more than that. I'm looking for significant share price growth. BT are not showing the hallmarks of that in their financials. There's nothing in their financials which would suggest to me that we're going to see that over the next 5, 10, 20 years. They're not efficient enough. There's no consistency there. There's no obvious trends there. It's certainly not in the right direction. And for me, when you are surrounded by the best part of 1,400 companies across the FTSE 100, the 250, the small cap, the fledgling, the AIM markets, when you've got that range of companies, really you should only be investing in the very best that are out there. Why invest your capital in a company like this when you've got companies out there that are providing far more exciting results? That's the kind of underlying story here. BT might go up to £3 a share in the future. They might even reach their previous highs of £5 one day. But you're not going to make a huge profit, probably. The average investor is not going to make a huge amount of profit on this going from £2 to, let's say, £4 a share. I want companies that are going to do far more work. I want the share price to go up far higher than that. And there are companies out there that are probably going to be able to achieve that for me based on their performance, based on their history, based on their underlying financials, the way they run their business, the way they're reinvesting for growth, and they're doing all the right things, and they have been for a long time. I want to see 10 years worth of trends. I want to see 10 years worth of consistent, repeated, correct behaviour, and BT are just not showing that. And it's for that reason that I know straight away now already, just in doing this quick analysis, that I'm not interested in BT. And I can discount them, and I can spend my time looking at the companies that do tick all those boxes, that are going to be a potential investment for me. And I'd much rather put my capital into those companies than a company like this that's trading at all-time lows pretty much. People will say to me, look, BT trading at £1.25, that's a steal, surely. BT are a huge company. Listen, sure, if you want to go from £1.25 and you want to hold that for the next 10, 15 years and hope to reach £4 a share eventually, by all means go for it. But I'm looking for far bigger returns than that. And for that reason, I'm out. I'm not interested. I sound like Dragon's Den then. But yeah, so let's go and take a look and see how they did on the leaderboard. Okay, so better than Vodafone. Definitely not quite as bad. Some kind of average results there. They're profitable for sure. But just because they're profitable doesn't mean they're a great investment. You want to see really strong profits. Listen, there are 1,400 companies to look at in the UK alone to invest your money into, as in publicly traded on the London Stock Exchange. More than that. If you know how to analyse these companies, then you know how to find the cream of the crop, the best of the best. It's just a matter of time and how much work are you willing to put in. Because analysing that many companies, if you're on your own, you probably won't get it done. I mean, 365 days a year, you've got to get several companies done a day just to cope with that, right? I have a team of people that I'm slowly bringing in and slowly employing that are doing a lot of the legwork for me, and then I'm running my analysis on top of that. And that I'm finding that is the best way we're going to get through these 1,400 companies per year. In the several hundred companies we've looked at so far on the Clean Trader, we've found, I would say, 30 that really excite me. I would say we probably found 50 that either really excite me or have real potential to do well. Now, if you knew of these companies, you wouldn't give BT a second look. Because why would you? There is an opportunity cost involved here, in so much that if you invest the capital that you have available into a company like BT, instead of one of these 30 companies that could do and are likely to do far better than BT, then you're missing out big time. You're absolutely going to miss out over the next 10 or 20 years. And so I guess the point of this episode, the point of this show of looking at BT is, one, to give you the facts, and two, to show you guys that these guys are not strong enough as an investment, as a long-term investment for capital growth, for share price growth. You won't get that with BT. They're not the right choice if that's what you're looking for. And in fact, there are far better companies. Companies like Taylor Wimpey and DGE are much better choices for you if this is your approach, if you've got a long-term investment approach where you're looking for the share price to grow. For me, BT are not that company. Of course, please do your own research, do your own due diligence on this, but for me, BT are not the company that I would be looking for. Time to get them up on the board then. We're not using the red pen, that's for starters, so that's a positive. The Epic code is BT.A. I'm just going to put BT here because we all know who they are. And I hate the Epic codes with the dots in them and the letters after them. I don't know why. It just annoys me. I don't know why. It's psychological. Who knows? They've done all right. But this is, I mean, the scores generally reflect pretty well these companies. You know, we've gone through the numbers. What were the numbers? What do the charts show us? Underperforming, not really going anywhere, average numbers, nothing particularly exciting compared to some of the companies we've looked at, you know, underwhelming, and the score reflects that. They scored 22 points, which puts them in 11th place. So very average, right? Very average results. Let's get them up on the board. So they sit there in 11th place. Like I said, very average. You can do far better, in my opinion, and very typical of the brand names, the household brands, the household names that everyone seems to know, everyone seems to invest in because they've heard of the company. Listen, if you work for BT and you've got some shares outstanding, I hope this video has been an insight. Thank you very much for watching. Please hit that like button if you are enjoying the show. And if you haven't subscribed yet, please do. We're going to be doing 2 videos a week now going forward. So hopefully we're adding value. Thank you so much for the comments as usual. And I'll see you guys later. Cheers.